Hey everyone, welcome to the Millennial Investing Podcast. I'm your host, Clay Finck, and as I mentioned in the introduction, our guest today is Ryan Reeves. Ryan, welcome to the show.
Thanks so much for having me, Clay.
So you've been on the Millennial Investing Podcast twice in the past. For those interested, those are episodes 55 and 74. For our newer listeners, could you tell us a little bit about yourself and how you got to where you are today?
Yeah, sure. So happy to be back on. And I've been investing nerd since I was 12 years old. I bought my first stock at 12. Surprisingly, I actually had a fifth grade teacher who brought in her husband to talk about the stock market. And for some reason, I was really interested and I sort of stuck with it ever since. So after I graduated college, I wanted to do something a little bit off the wall. So I started an investment research firm called Investing City. And here we are almost 4 years later. So the idea is that I'd have all my portfolio transparent on the website for members, and then all the research reports, weekly updates, and everything else is kind of surrounding this transparent portfolio, and there's a community with all the members. And so I just study businesses full time, and I just get to pinch myself because I love it so much.
Now, in today's episode, we're going to be doing a bit of a deep dive into Tesla. Before we do that, I wanted to touch on some of your overall investment philosophies. How would you describe your overall investment strategy?
Sure. So I think that I don't love the growth versus value distinction just because, Warren Buffett talks about it. Growth and value are just two sides of the same coin. And if you have a company that's growing really fast, it could be definitely a value investment, even though multiple might be higher than people think, is a good idea to buy at. So I guess, but if you have to sort of put a label on it, I would say it's definitely more fast-growing companies. The way that I think about it is I'm trying to find the highest quality, fastest-growing companies. A lot of times companies that, like some biotech that's growing 400% because of, just some drug was approved and they're getting it rolled out. That might be the fastest growing, but based on my circle of competence and just the overall market dynamics, it might not be the highest quality. And then you can have very, very high quality companies, like Microsoft, Google, etc., but they might not be the fastest growing anymore just because they're so big. And so I'm really trying to find that perfect mix of high quality and fast growing companies. And the way that I think about it is, if a company is growing really fast, that shows that there's really high demand for their product. And, that's what business at the core is really all about, delivering a great value proposition to customers. And then the other thing is, you want a team that is executing really well. You can be selling dollar bills for 90 cents and growing incredibly fast, but if you're not executing well and having a clear value proposition for customers and capturing that, then there's really not a viable business there either. So really ideally you can have high growth and high margins, and that's really a sign that they're executing well, and there's some signpost of a moat. So that's really how I think through the strategy. And then there's other factors, like I love founder-led companies. I think every company in my portfolio right now is founder-led and looking for big tailwinds, big industry tailwinds, just because you have an industry that's low growth and it just becomes harder to execute. Tailwinds kind of lift your boat a little bit easier. And so there's just a few things that I look for.
Now, if I remember your background right, you interned at the Motley Fool, and when I listened to kind of your strategy, you look for those growth companies and you look for the highest quality, and that definitely falls in line with the people I've listened to from the Motley Fool. So I find that very interesting how many of you kind of have that philosophy where you look for the highest quality companies you can find and hold those for the long term.
Yeah, I would say that there is a strong contingent of fools out there that, the Motley Fool does really good work, and I had a great experience learning there. So yeah, I'm a big fan of the Motley Fool.
One of the most difficult parts of investing in these higher growth companies that are very high quality is the valuation. how do you look at valuation? Do you have financial models you use, or what type of analysis do you do when valuing and determining, yes, this is the right price to pay for a higher growth company?
Sure. So I have a few thoughts on this topic. And one thing I would say is a lot of times we fall into the thinking where we just want to compare multiples across all companies and say, okay, this multiple is lower, therefore the company is cheap. This multiple is higher, therefore this company is more expensive. But that's really a very simplistic way of thinking. Each business is its own unique thing, and each business has different characteristics. So okay, maybe the multiple is higher, but this company might be more dominant. The industry might be growing faster. Management might be stronger. Overall growth and margins are higher. And so you can't just reduce it down to a multiple. There's so many factors that I actually look at valuation towards the end of my process rather than the very beginning, because if I'm looking at this company as a unique entity and studying absolutely everything about it, trying to get a holistic picture of what it's going to grow like and how dominant is its market position, then valuation is in its proper context then, and you can kind of compare it against other companies. And that's kind of the problem is we want this nice, easy formula, but if you're going through the whole process of studying a company and then trying to compare multiples across different companies, across different industries, it becomes a whole lot more complex because there's a lot more gray area. It's like, well, how do I value a stronger management team, and what's the magnitude of that strength versus the other company, and how do I factor that into the multiple? And so it just becomes a lot more gray area, and I think that that's the thing that a lot of people don't really want to deal with. It's much easier to say, oh, Facebook's at 18 times earnings, and Microsoft's at 30 times earnings. Facebook's way cheaper, and that's just so much easier to do. So I think that the nuance is really important to think of. But in terms of how I actually just calculate valuation, I try to look 5 years out, try to get a solid estimate of what I think growth could be, and then what I think margins could be, and what I think is a reasonable multiple, and then sort of discount that back to the future and just see what's the expected return of that. So it's really nothing fancy, and I'll do it with different scenarios. So, okay, if they really outperform my expectations, maybe growth is much higher, and then that might trickle down to the bottom line, so margins are a bit higher. And maybe with those characteristics, the multiple should be a little higher, and sort of run different scenarios and then kind of try to put some probabilities on the weight of those scenarios to get like a blended valuation that I think is sort of reasonable. So it's definitely a lot of work, but it's not, like anything too crazy. But I try to look out 5 years rather than sort of look on a trailing basis. I actually don't even look at any trailing multiples. I'm always trying to look out forward because I think the market is inherently forward-looking, especially with this type of companies.
I think it's important you mentioned the qualitative factors. It's hard to say for Tesla, for example, it's hard to put a value on, okay, what's the value of Elon Musk being the CEO of the company? It's really hard to factor that into a model, and it's really hard to figure out how much weight the market's putting on that. And I want to touch on Warren Buffett's number one rule of investing is to never lose money. Part of this rule stems from the fact that if your investment loses 50% of its value, it takes 100% gain to get back to where you started. So are you doing anything to manage risk in your portfolio and ensuring that you aren't taking excess risk?
So I think the main thing that I do around managing risk is position sizing. And my position sizing is really based on a mixture of my conviction in the company and how much upside I have in it. So it's really conviction, meaning really longer term downside. Do I think this company is susceptible to serious disruption? And the way that I view risk is really permanent capital impairment. So volatility honestly doesn't affect how I think about things too much, because there's been multiple times where my portfolio has been down 40% over the past 8-10 years. And it's never fun, but I think it is sort of the price you pay when you play in this sphere of the market. So yeah, while the math says, okay, you're down 50, you have to get back to 100, some of these companies can go up 100% quite fast. So I think that, it's definitely valid, but Warren Buffett also says that you shouldn't invest in the market unless you're willing to lose 50%. So there's clearly just that's sort of the price of admission to the stock market. But and it's never fun when you're down that much. But volatility, as long as the business is continuing to execute, I try not to let it rattle me too much.
Yeah, you mentioned conviction, and I think that point is really important when investing in these companies that have higher volatility. Seeing a 50% downturn is very possible, and that might not even be due to drastic changes in the fundamentals. So if you've done your research and you built that conviction and a 50% downturn occurs, that, the fundamentals are still there and the long-term thesis is still intact. Am I right in that assessment?
Yeah, that's why I think conviction is so important. If you have no idea why you're holding what you're holding and things go south, I would say 50% is maybe extreme for absolutely nothing to happen, but during COVID, that was obviously a huge exogenous shock, but things were down 50%, that even like software companies that supposedly were going to get a boost from COVID, and some of them were down 50%. So you could say, hey, there's actually this added tailwind, but even they're down 50%. So yeah, I think it's definitely interesting, and that's why conviction is so important, to know exactly why you're holding what you're holding, and you have the conviction from all the homework you've done, rather than you've got a stock tip from a friend and you have no idea what this company does, you have no idea what the main competitors are, you have no idea if this company is in a dominant market position. So you just have no foundation to stand on, and that's scary, and that's why you'd be super nervous when the stock is down so much. And it's not like I'm not nervous. I just have more confidence in the actual people running the business, and I even know them by name, and I just understand what they're doing on a daily basis to sort of move the business forward.
How many holdings do you typically like to have in your portfolio? Some argue that you should concentrate on a smaller number of holdings that you know very well. Others might argue that you want to diversify into a number of different companies to spread out your risk.
I try to be fairly concentrated, so anywhere between 8 and 14 companies, actually. I think right now I'm at 9, and the reason is I think concentration is important for extreme outperformance, actually. I used to be much more diversified and, this company is a tech company and I need to make sure that I have a different industry to make sure that I'm more sector diversified. And what ended up happening is I'd have real small positions that would do very well, and 1% position might triple, and added 2% to my performance. And I was like, I did all this research on this company, I have built this conviction, and it added 2% to my annual return. And at some point I was like, why am I starting positions so small and I'm not adding to them? And so it's sort of just this process of frustration sort of led me to a few little rules. So I try not to have position sizes that are lower than 3%, even try to do 4% now. And the reason is if I don't have the conviction in this company and I'm just sizing it small, then either A, it's not a no-brainer, or B, I haven't done enough research on it. And so I think that having enough skin in the game really incentivizes me to know absolutely everything about the company as well. And then that also allows me to, when these companies actually perform well, it's a bigger percentage in terms of return for the overall portfolio. And there's obviously an added risk when you size something big and it goes wrong. But that also really incentivizes you to make sure that you make really thoughtful decisions. So I think there's a double-edged sword, but overall, I'm a fan of concentration just because it makes you stay really sharp, and then it also can really add some outperformance in terms of your portfolio.
So one thing that has been on my mind recently is inflation. Intuitively, I would think inflation could have a negative effect on my stock portfolio because it can lead to higher interest rates and lower valuations. How do you think about inflation and how it relates to investing in these higher growth companies?
Yeah, I think that there's always a macro factor that's kind of hanging over stocks, and there's always, honestly, any time you're investing, there will be something that people on CNBC are talking about, that it's, worrying, whether it's interest rates were rising, whether it's a China trade war or Greece going bankrupt. Like, there's so many factors just that you can find over the years. And I would say more times than not, they are distracting from the overall process of investing. But inflation is really interesting because the reasons that you just said. And the way I look at it is, if a company is capital light and has really low material costs, then inflation, I mean, if this company is growing 100% and there's 3% inflation, is that better than a company that is growing 7% and has 3% inflation? So it just seems like if you're growing very fast, it provides almost a contrast in a low growth environment versus companies that are maybe growing much slower. They're very capital intensive. They have high material costs. So yeah, I'm really not sure exactly where it all plays out, and that's usually my answer. I mean, I just have no idea. But I think that if companies are growing really fast and they're capital light, then I tend to think that inflation won't have as drastic of an impact on them. But like you said, we don't control interest rates, and I guess we'll kind of see where it goes.
Now let's talk about Tesla. First off, I just wanted to give a full disclosure that neither Ryan or I own any shares in Tesla ourselves. This will just be an open discussion of the company and the bull and bear cases for the stock. And this is a pretty timely interview, as just this week in later October, there was an announcement that Hertz is going to purchase 100,000 Tesla vehicles between now and the end of 2022. And Hertz, the rental car company, also stated that they want over 20% of their rental vehicles to come from Tesla. And this sent Tesla stock to over $1,000, and the company hit $1 trillion market cap for the first time in the stock's history. Do you have any comments you'd like to add regarding what we've seen from Tesla and the news from Hertz?
Yeah, I mean, it's really interesting. I think that it's probably likely that other rental car companies will follow suit, as it probably just makes a lot of sense. I think that even in the future, as these car costs will continue to go down just because battery production gets better and better, I don't see why this wouldn't be another tailwind. And I mean, we were just talking before the show, this order represents $4.2 billion, which is a little bit less than 10% of Tesla's total revenue. So this is a serious order, and yeah, I think it's just a validation that Tesla's technology is obviously really good.
So one thing that comes to mind when I see this news and how big of a deal it is for Tesla is just the advertising perspective. Like, hundreds of thousands, if not millions of people are going to get exposure to Tesla's vehicles, through this rental car service if they're using Hertz, which is pretty amazing to think about, since Tesla does not spend any money at all on advertising.
Yeah, that's something that I didn't even really think of. But when you get a rental car and you get a Tesla, it's just free test drives for Tesla all day long, which, it could be interesting. If you've never driven a Tesla and all of a sudden you get one as a rental car, you're like, wow, I need one of these.
Mm-hmm. Yeah, I've test drove a Tesla Model S myself, and, I don't own the stock, but when I test drove this, it was just an incredible experience. That's what you find with some of these incredible companies. It's just the experience they provide, and that's how they differentiate themselves. Is it's not just just like a better car performance wise. It's the overall experience that they provide to their customers and that they really hone in on.
Yeah, I think it's interesting. There's sort of a meme about Tesla where it's like people who are shorting the stock, and then people who have the stock, they're like, well, you've never driven it. Like, once you drove it, then you'll understand sort of the hype around it. So I think there is something to that. Wow, this customer experience is so much superior to a normal driving experience that I think that it's easy to underweight that, but it's very important because that's the core of business, trying to provide a superior value proposition. And if you can do that, then way better than competitors, then that is almost by definition a good business.
It's obvious that pretty much everyone knows that Tesla is an electric car manufacturer. Tell us about some of the other things Tesla does and how exactly they're disrupting the car industry.
Sure. So I think Tesla has some of the most optionality of any company. I think meaning they can really expand into a lot of other business lines. So the mission of the company is to accelerate the world's transition to sustainable energy. And you'll notice that nothing in there mentions cars. So I think that cars are really just the first piece of the puzzle. And Elon's even at times talked about how he thinks the energy business could be bigger than the car business. And when I first heard that, I was really, really skeptical. But I think that if you look into it a little bit, they have solar panels, solar roofs, the power walls, mega pack battery packs. So they really have this vision of building a distributed electric utility. And they're even selling some of their softwares, like there's one called AutoBidder that a utility in Australia uses to kind of manage how they're routing electricity to different homes. And it's kind of crazy that the company is so involved in projects like this, but then they have, even on the last earnings call, they talked about insurance. So having individual insurance policies for every Tesla driver, depending on your driver behavior, and it's sort of updating in real time. So if you're a super safe driver, you don't have to get this higher premium to sort of offset the risk of some riskier drivers in the insurance's basically in the pool that the insurance company covers. And so they're doing some really innovative things there. They even have AI supercomputer named Dojo that they've been talking about. Maybe we'll offer this supercomputer as a service. So there's all sorts of crazy stuff they're doing. And they have the full self-driving. It's not quite there. It's still getting rolled out, but maybe they could offer that as a service to other companies. And it's just crazy the amount of innovation that's going on at the company. And batteries are getting better and better, cheaper and cheaper. Cars are charging faster and faster, and so it just seems like there's really so much. If you know the ARK investment firm, they've been talking about robo-taxis for a really long time, having this distributed network of robo-taxis. And who knows where everything goes, but they've really got a lot of irons in the fire.
Now, you mentioned many of their other lines of business, but currently the majority of Tesla's revenue comes from the car business. And I think that really needs to be like the foundation of their company going forward, is what I would think. So in preparation for this interview, I was listening to Tesla's annual meeting, and Elon Musk said that Tesla is just as much a software company as much as it is a hardware company. So what do you think makes their cars so special relative to some of the other manufacturers? Because we know some of these other car companies are going into the electric vehicle space. They're prepping for that potential transition in the near future. So I would think that they really have to differentiate themselves on the software side, like Elon is saying. Could you expand on that?
Sure. So I think it's really interesting, especially if you even compare Tesla and the type of people they hire versus a traditional car manufacturer, I mean, if you look at the number of software engineers at Tesla versus at GM or Chrysler, it's not even a comparison. And I think that shows up in things like over-the-air updates. I mean, with Tesla, if you're a Tesla owner, you can, boom, get 5 more miles of range just by downloading a new software. And it kind of boggles my mind how that even works and how they can make things more efficient in the car through the software, where you can just download something and boom, all of a sudden you have a performance upgrade. And the legacy manufacturers have not cracked that code, and it's because they're trying to sort of rewire cars that have been built so long ago. Like the models have been created, and it's just a totally different way of thinking. And so I think that is what Elon might be referring to when he says that it's really more of a software company than a hardware company. But at the same time, they spend so much time on the design of the car and trying to get everything right, whether it's the crazy thing is Elon talks about time and time again how hard manufacturing is, and that's obviously the hardware piece of it, and they do so much to try to ramp production. It's pretty crazy just that what goes into the factories that they have and the automation in the factories. But I guess the automation is even software for the robots that are creating the cars. And one of the most impressive things about Tesla to me is how vertically integrated the company is, meaning it's really all the way down. So oftentimes, if they can't find a perfect part for their vehicles, they will actually create the machine to create that new product. And so they basically are just constantly creating things rather than pulling things in from new suppliers. I mean, they do get the cells from Panasonic, and they can't build absolutely everything themselves, but they do create there's just an insane amount of vertical integration, which I think is really, really impressive.
That reminds me a lot of SpaceX. Elon and his crew went over to Russia to figure out, okay, how are we going to get a rocket put together? And Elon tells his guys, hey, how about we just build a rocket ourselves? And they thought he was crazy. And before you know it, him and his team were able to put together a rocket for like 10% of the cost of what NASA could do. And just thinking about that and how Elon has these production facilities at Tesla, just the guy obviously understands production and how he can increase efficiency, decrease costs, bring things in-house. And it's just incredible to think about how he's done this with not only a rocket company, but a car company as well. And I wouldn't be surprised if he would be able to drastically reduce the cost of producing a car at some point in the future.
Hey everyone, Clay Finck here, host of the Millennial Investing Podcast. Today I wanted to tell you guys about this exciting new investment tool called Titan. Titan is an investment platform for everyday investors that want their money actively managed by a team of experienced analysts. With how hectic life can get at times, why not outsource your investments to the experts? They offer 3 equity portfolios and America's very first actively managed crypto portfolio. Their funds have continually beaten the market since inception, and they aim to grow your investments by 15% annually. At this rate, this would imply your money doubling every 5 years. My favorite fund is their flagship fund, which invests in the highest quality large cap growth stocks in the US. Join the smarter way to invest with Titan. All it takes is $100 to get started. Right now, if you sign up through our link, titan.com/TIP, you'll get your first 3 months of investment management for 0 fees. That's titan.com/TIP for 0 fees.
Yeah, definitely. And just to talk a little bit more about the software, it's pretty crazy just the number of miles that Teslas have driven compared to the next autonomous competitor like Waymo or something. I think if you look at, there's certain estimates between like 500 and 1,000 times more miles have been driven in Teslas than Waymo. And it's just the pure amount of data that they're getting. And they talk about this a lot, the edge cases where really random things happen. So you're driving down a freeway and a truck drops whatever's on the back of their pickup. And it's like, okay, what's the car going to do in that situation? Or there's like a jacket draped over the stop sign, and it like sort of distorts the stop sign. And it's like, there's so many different little edge cases that really make up what is the real world. And it's hard to get all of that data if you're not having this, millions of fleet of Teslas that are constantly collecting data and sending it back to the Dojo supercomputer that can then have insights on what the car should do in certain situations. So I would say that there's also a huge flywheel there where they're getting so much more data than the competitors, meaning the insights are better, and so they can roll that out to the huge fleet, and then it just keeps getting better and better, and it's like this snowball effect. And so I think that's another piece of sort of the software moat there.
Yeah, I agree that the data will be very valuable for them going forward, especially if they're able to collect much more than their competitors. And I wanted to touch on their current market share. So Tesla's vehicle sales currently make up roughly 1% of the market in the US, while the valuation of Tesla is more than the top 10 automakers combined. You take all those automakers' valuations and combine them, it's still less than what Tesla is valued at. So I'm curious what you think realistically within, say, the next 5-10 years, how big of a market share for car vehicle sales can Tesla achieve?
Yeah, it's really interesting. I think that I've seen that chart so many times as Tesla has kind of grown in market cap, like, market, how many cars Tesla's selling versus its valuation compared to Toyota and all that. And I always thought I was sort of missing the point a little bit. As I mentioned a little bit earlier, I think the market's always forward-looking, and that chart is inherently backward-looking. And it's like, well, are you incorporating all of the massive production feats that Tesla is really creating themselves, and the tailwinds of electric vehicles? And I mean, it's easy to sort of look at that chart and say, like, how stupid are you if you buy a Tesla? But like I said, there's so much nuance. I mean, so just some brief metrics. I mean, there's somewhere around 70 million cars that are sold each year. And so that's kind of like the upper limit. And last year, Tesla mentioned that their goal is to get to 20 million cars produced every year. And we're not exactly sure how long that'll take. I mean, right now they're at about 1 million run rate. And so 20x increase in production is definitely no small feat. I mean, they're going to have to create more gigafactories. They just kind of broke ground at Austin. They're still ramping up Giga Berlin. So there's so much that goes into increasing production by a factor of 20. And but I mean, 20 million cars versus 70 million is, roughly like 30% market share. And Tesla says by 2030 they want to be able to produce 20 million cars. So, within the next 10 years, that would be theoretically 30% market share, which I don't think is, insanely unrealistic. I mean, one thing about Tesla is they set these huge goals, like way higher than anyone thinks, and then they usually miss them, honestly. And the thing is, it's sort of like if you shoot for the stars, you land on the moon sort of thing, where the goals are so high that they're really gunning for them, and then they end up farther than they would have if they just set like a normal goal. So I think that that's sort of the ethos of Tesla. A lot of times people get freaked out of, they missed production, delivery time, and, they came in behind the estimates. It's like, well, yeah, but the estimates are so unrealistic that it's just hard to kind of keep them accountable to that, but they still just keep trekking on because they do have such high aims. So I honestly don't know whether 30% is like in 10 years is the right number, but that's what Tesla's gunning for.
You mentioned how they shoot for the stars and end up still landing on the moon, and that itself is an incredible feat. And that brings me to Elon Musk. He's kind of this, this CEO you don't see very often, kind of like Steve Jobs, how he's just so hard and pushes for these massive goals and just a relentless work ethic. And the critics say that Elon makes these outrageous predictions. They're impossible to hit, and they'll never be able to do it, while his supporters are, have fallen into this almost cult-like following, and they'll almost believe anything he says. I'm curious what your take is on Elon Musk's role with the company and where he's taking them going forward.
Yeah, I mean, I've got to say, I think I've underestimated Elon. It's really quite amazing what he's pulled off. It really, really is. I think that, honestly, he'll go down as, up there with Thomas Edison in terms of the contributions as an inventor and as a person who really pushes innovation forward. I mean, the thing about Elon is he's so hands-on as well. It's not like he's sitting in his office and letting all the engineers do what they do. I mean, he's really involved in design. He's really involved in the actual manufacturing and engineering. I mean, his past earnings call, so last earnings call, he mentioned that he wasn't going to do earnings calls anymore. And part of me was like, oh, wow. And then, I kind of was skeptical. I don't know if he's going to just start blowing off Wall Street. But sure enough, this earnings call, he wasn't on there. He let the CFO do most of the talking. And he did that so he can be focused more on the product and more on actually moving Tesla forward. And the stock price will obviously follow, as we've seen. So I can't say enough about how just purely innovative he is. I mean, he does do some really crazy things, though. There was a couple years ago, he had the 420 secured thing, the funding secured at the stock price of 420. And it's that seems fairly illegal. And there was the whole SEC investigation. And so there's this two sides of the coin. But if you have a person as eccentric as he is, there's always another side of the coin where you can't expect him to be all perfectly buttoned up and your typical corporate exec. It's you can't really get one without the other. And so I think that's something that I underestimated for too long.
In thinking about this electric vehicle transition, I believe you're in the Los Angeles area. Is that right?
Yeah.
And, I haven't been to California, but I'm sure that there are Teslas all over in that area. And I visited Seattle, Washington recently, and I saw Teslas everywhere. And I'm actually located in Lincoln, Nebraska. I'll see Teslas around, but I'm sure it's nothing like what you see in, say, California or Seattle area, for example. Do you see any friction in people transitioning to electric vehicles at a mass market level, whether that be maybe the time it takes to charge a Tesla or just resistance in going from gas to electric? So what are your thoughts on that?
Totally. I honestly think what you mentioned is one of the bigger friction points, even just the charging times. So, I mean, if you're doing a road trip where you're going from Southern California to Northern California, you have a range of, say, 300 miles. And so you drive the 300 miles, but, you're not supposed to get it down too low because that's actually harmful to the battery. So you have to leave a 20% charge. So then you have 80% of 300. So you have more 240 miles. And that will go pretty fast. I mean, 4 hours of driving, and then you have to pull off. And it might take 30 minutes to charge versus 5 minutes at a gas station. And so there's this small friction that I think people are... I can't just get up and go do a road trip with a Tesla. I have to really plan out charging stations. And, I might be in Nebraska where there's no charging stations around. And it's well, how do I charge my Tesla? You have to be very intentional about your route planning. So I think that's actually a big thing. But what people might underestimate is actually that technology is getting better and better. They even just mentioned that they upgraded their supercharger, and there's improvements in the battery technology that can actually reduce charge times. And so I think once you get it down to that same amount of time versus filling up and charging, then it's what is the thing that's really holding you back? I mean, better performance, lower costs, you don't have to pay for gas, same charge times. It's then it's more like an ideological thing. It's like every logical thing is checked off. You just like the sound of your gas guzzling car. It's like that's really the only thing that's like the last bastion. So I think charge times is actually really important that they get that down.
I definitely agree with you. Now, there are a lot of things I like about Tesla as a company, but the one thing that has held me back from investing in them is their valuation. At the time of this recording, they're over $1 trillion market cap. So when I look at that and I just compare it to other opportunities in the market, I just see better opportunities that I like more just from a risk for reward perspective. What do you think about the valuation of Tesla?
Yeah, so this is the the factor, right? I mean, it's really interesting thinking of the biggest upside scenario. I think that oftentimes within investing, we think about downside so much. It's like, okay, what are the worst possible things that could go, like they could go wrong, and really an intense focus on the downside. I think that's very important. But I don't think that there's the same focus, or at least the same extent of the focus on thinking about like what are the things that could go really right. And I think that Tesla has one of the I mentioned like the amount of optionality it has. Things could go really, really right with Tesla, and that's obviously incorporated in the valuation. So, if they hit 20 million cars in 10 years and they have an average selling price of, like $40,000, that's $800 billion in revenue. I mean, that's pretty wild. This last quarter, they did 15% operating margins. Maybe with some manufacturing efficiencies, they can push that up to 20%. So that's $160 billion of earnings. I don't know what the correct multiple on that is, even if it's 20 times. That's $3.2 trillion in market cap. So that's a 3x over 10 years, which is certainly nothing to sneeze at. And that's only the car business. I mean, that's not even mentioning energy. That's not even mentioning the other things I talked about, not even incorporating full self-driving, which is basically pure margin, insurance, which is basically pure margin because they have all the data on individual drivers. So you can sort of see that, like, okay, it's $1 trillion company, but I mean, it could theoretically, it's not maxed out in terms of its market opportunity. Really, the risk is that the valuation gets so large that even with amazing performance for 10 years, there's no way you can get any returns. And I'm not sure if we're at that point yet, but I guess you can really see that the upside, like if things go really right, there's still room for the stock, but there's obviously the other side of that where, traditional manufacturers are really trying to go full throttle into electric vehicles. There's some upstarts. And then, there's execution risks. I mean, it's very, very difficult to produce all these cars, and for a long time Tesla wasn't making any money, which was this huge risk of they're going to have to just keep diluting themselves and diluting shareholders. But as soon as they started making money, we saw the stock go up like 30x, and so that was like clearly the main thing that was holding back the stock of, is this company going to be even solvent? I mean, there was some real worries that Tesla was even going to exist as a company, and shorts were really talking about, like accounting gimmicks that they were pulling off, that they were trying to make money. And I think that was really the key there of, okay, if Tesla's actually making money and they're self-funding, then the upside is virtually unlimited because the existential downside has been limited quite a lot. And so, yeah, I'm like with you. I've sort of always been said like, oh, well, Tesla is so much more expensive than traditional car manufacturer. Just doesn't make sense. But I think I was really missing the big picture of what could really go right about this company.
So when valuing a company like Tesla, a quote-unquote value investor might come up with a very low valuation just solely based on the numbers. And what they wouldn't be accounting for is, like you discussed, the optionality of the company moving forward. And you touched on this earlier with the insurance, the energy, and the different, areas they could dive into going forward. For example, Elon mentioned that they could, sell their autonomous driving software to the other car companies if, it's easier for them just to buy what Tesla has, and it's because it's superior, and they don't have to make those investments and develop it themselves. Since there's so much optionality, I'm curious, what do you believe that are the biggest opportunities for Tesla going forward? There's just so many different areas they could go into. Which ones do you think are the biggest opportunities for Tesla?
Sure. So it would be really interesting if they started offering their self-driving to other companies. I mean, it would sort of be like, okay, if they can get their software into other cars, and there's even that bigger fleet that is improving the data, it kind of seems like game over to me, honestly, because it's sort of like, what other company is going to best them in terms of the amount of data that they're getting? And then it almost becomes like a design preference for customers. It's like, okay, you're full self-driving, so you don't have to worry about that. But it's like, what kind of car do you want to roll around in? And so it's really quite interesting. I mean, the other thing is, even with the energy business, so there's estimates by 2024, about 2.5% of homes will be powered by solar. And so if you do that math, that's about 4 million homes in the US. And average cost of a solar roof is something like 40 to 50K. So even if you just go off of that, that's a $200 billion market. And these are gigantic markets. I mean, compared to a normal total addressable market, I mean, even software companies that are like really quite large, they might have TAMs of 50 billion, but this is just one piece of Tesla's business. And, it just kind of going back to the optionality, there's so many directions that this company can go in, and there's so many huge markets. I mean, the mission is amazing: accelerate the world's transition to sustainable energy. There's so much that can fall under that. And they're really starting with, solar and cars, but it'll be interesting to see what they dream up one day. I mean, I don't want to get like all fanboy on the company. I mean, there's still a lot that needs to be done in terms of production, and it's right of them to focus on cars because that's the first thing, and they make the vast majority of their money from that. So yeah, I guess we'll see, but there's quite a lot of optionality.
Yeah, I would definitely say we've talked the company up quite a bit up to this point, and let's talk about the risks. In your mind, what are the biggest risks for Tesla going forward? I'm assuming you've thought about this a little bit since you don't own Tesla and you like owning higher growth companies like Tesla. So what are the biggest risks you see?
Yeah, sure. So, I mean, one of the things that's really kept me out of the stock is I thought there was a huge reliance on Elon. So if something happens and he's spending his time in so many different directions with SpaceX, Neuralink, Boring Company, like there's just so many things that he's doing that I thought that it might be hard for Tesla to continue to just crank out cars. And, obviously I've been very wrong on that. But I thought there was this huge reliance on Elon, especially with some of the things he's done with the whole SEC investigation, like pumping Dogecoin. And it's like, I just don't know how I feel about that as the leader of this company that, is doing so many amazing things. But then, like, I see him on Twitter and I'm like, there's kind of this discrepancy here. But I think I mentioned this, you can't really have one without the other. If you have such an eccentric person, there's he's not going to be perfectly buttoned up as your typical corporate executive. And then obviously the other thing is the valuation, as we talked about. I mean, $1 trillion company, there's high execution requirements. I mean, if the company doesn't execute, if they don't get anywhere close to that 20 million barrier by 2030, the stock could go sideways or lose value for quite a long time. So there are really high execution risks. I think one thing that I thought was a bigger risk was competition. I mean, there's always fears about, GM's going fully electric now, and, whatever company is starting to go fully electric. And it just seems like there's such a big distance between Tesla and the competitors. And I think that that's something that I miss, of really focusing on that, and that being a determining factor. So yeah, I mean, there's valuation, Elon sort of risk, and then execution risks. I mean, manufacturing is an incredibly hard problem. Yeah, I would say those are kind of the main ones.
Tesla has bet big on China as they are building a gigafactory there. And China is also a country that has banned companies like Google and Facebook from even operating there. Is there a chance that China could crack down on Tesla so that the Chinese government can prevent them from gaining a substantial level of market share?
Yeah, I think it's certainly quite possible. So there's other Chinese manufacturers out there like NIO, and I just think that the Chinese government has made it fairly clear that they favor their own companies rather than foreign companies. So I think that the fact that China, Tesla has a gigafactory in Shanghai is really important, that they're highly aligned. It's not like they're just shipping cars in, and I think that the Chinese government would probably frown upon that a little bit more. But it's an interesting risk that you bring up, and one that I think should really be thought about deeply if you're a Tesla investor. Because I'd say it's quite possible. It's hard to know exact probabilities, but yeah, it's definitely something to think about.
It seems like almost every few months I see something in the news where there are Tesla recalls, and it's just like thousands of vehicles are being recalled. And I wonder, do you know if that could hurt the company substantially from a financial standpoint at some point?
I guess it would be the number of recalls. So, just in terms of the total fleet, like I don't know how many cars are being recalled in most of these reports, and yeah, it's definitely possible. I think that another thing that you see in the news a lot is some person was on autopilot in Tesla and unfortunately crashed, and so Tesla should be held liable for that. And it seems like time and time again, there's sort of, as the details have come out, it's like somebody was sleeping or not really paying attention, and they say that you need to be paying attention. It's not like completely autonomous yet. So I think that there are sort of a lot of news headlines that come out, but I think that that's also one of the risks as we transition to autonomous driving. I mean, unfortunately, so many people are killed in car accidents, and I mean, if you just look at what's possible, I think like it'll be maybe 50 years from now, we'll say to our grandkids, we'll say like, how on earth did you guys let each other just drive cars and sort of have all these accidents? Like it would be almost viewed as barbaric if we have autonomous driving and basically zero accidents. So, I mean, that's, I would love if that happened, because it would show that, I mean, the pure amount of deaths would go down exponentially. So I'm hopeful, but I think that there's a lot of news headlines that obviously will take place from here and that hopeful future.
At the end of each episode, we like to have a segment called the action plan. In this segment, we like to ask the guests 3 questions that can create an action plan for listeners to do when they're done with the episode. So the first question, which habit or principle do you follow in your life that has had a big impact on your success that not enough people do but should?
That's a great question. I think one thing I try to do, definitely not always successfully, is just take the other side of the argument just for fun. So like Tesla, I don't own the stock, but trying to think of the most bullish case just for fun, to try to like almost stretch my mind, or a company that I really like, try to look at the most bearish possible case. To just, I think so often it's easy to get locked into tunnel vision. It's like what I think and what I see is correct, and that's the only way, versus just taking the complete opposite of that argument. I try to get in that habit, and it's really uncomfortable, quite honestly, but I think if you do it enough and kind of exercise it, it can be really helpful to see things from different angles.
I really like that. Confirmation bias is something that's very real. You know, if you're the biggest Tesla bull, you might only read content from people that are also Tesla bulls. And, you know, if someone has a legitimate case for why the company might not do so well in the future, then you're likely to try to avoid that content. So I really like that and how you, look at both sides of the argument.
Yeah, thanks. I mean, it's kind of crazy just how, like, if you read something that you really disagree with, you automatically almost think of this person as like a bad person. It's like you have no idea what the character of this person is. It's just like they have a very different worldview than you. That doesn't mean they're a bad person at all. You have to like sort of separate the person from the content. And it's just, as humans, we're super, super bad at that.
What has been the most influential book in your life? It doesn't have to be your favorite, just the most influential. Sure.
So my faith is really important to me. So it's kind of like the cop-out answer, but I'd say the Bible is definitely the most influential. But investing related, I would say, is One Up on Wall Street by Peter Lynch. That really got me fascinated with the stock market and tons of great real-life examples.
I'm actually reading that book right now and really enjoying it.
That's awesome.
So when this episode is over, before the listener quickly jumps to the next podcast queued up in their player, what is one action that they should take to help improve their life, career, business, or just their investment strategy?
Yeah, I think the one practical thing is keeping a decision journal. So whether it's actually like a physical journal or just a note on your phone or your laptop of all the decisions you make. I mean, so investing is a really easy example of every trade you make. Write down exactly why you made the trade. And so this is pretty humbling, actually, because let's say the stock doubles and it goes up for a completely different reason than you said. It's like, okay, the results say I'm right, but I was actually wrong. And so if you look at this decision journal over time, it really just shows you like how overconfident we can be. So I'd say that just track your decisions, and it will help you also remember, obviously why you made the decision, and then it can be kind of humbling. Or if you do get it right, then you can update your process and say, okay, that was actually a good decision, and here's why I made this. And so you can sort of build this pattern recognition, because we can fool ourselves very easily.
Ryan, thank you so much for coming on to the show. I really appreciate it. TIP does too. And I really enjoyed this conversation around Tesla and your overall investment philosophies. Before we close things out, where can the audience go to connect with you?
Sure. So if you just type in Investing City, Investing ING, City on Google, you'll find my website. And you can also find me on Twitter at investing_city. I have DMs open, so feel free to reach out. I always love talking to people.
Awesome. Thanks so much. We'll be sure to link those in the show notes. Ryan, thanks so much for coming on.
Thanks so much, Clay.
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on our next podcast episode and new investing resources. What are your takeaways and thoughts about this discussion? Let us know in the comments section below.